Want to know which investment could give you higher returns? High-yield bonds or stocks? Stick around because today we're diving deep into the world of investing to uncover the truth behind these two powerful asset classes. Now let's set the stage. Imagine you're at a crossroads. On one side, you have high-yield bonds, often called junk bonds, which promise greater returns than traditional bonds. On the other side, you have stocks, which have the potential to soar like a rocket but can also crash unexpectedly. It's an exciting dilemma, isn't it? First up, let's talk about high-yield bonds. These are debt securities issued by companies with lower credit ratings. That's right, they're riskier, but they come with juicy interest rates. For instance, if you invest in a high-yield bond with a 6% interest rate, you're likely to earn more than you would with a standard bond, which might only give you around 2%. But here's the catch. If the company goes under, your investment could take a nosedive too. Now, picture this. 5 years ago, you invested in a high-yield bond from a struggling tech startup. Initially, it seems like a win. Those interest payments are rolling in. But suddenly, the company files for bankruptcy. Poof! Your investment evaporates. High-yield bonds can be thrilling, but they come with the risk of losing your principal. Now let's shift gears to stocks. Stocks represent ownership in a company. Think of them as shares of a rocket ship. Fast, exciting, but also unpredictable. Historically, stocks have outperformed bonds in the long run, averaging returns of around 7% to 10% annually. Imagine you bought shares of a tech giant like Apple 5 years ago. Those shares could have nearly tripled in value, not to mention the dividends you'd earn along the way. However, stocks aren't all sunshine and rainbows. They can be incredibly volatile. Market fluctuations can turn your profits into losses overnight. If you bought at a peak, like in late 2021, your investment might have taken a hit when the market corrected. So, how do you choose between these two? Here's the secret sauce. It all comes down to your risk tolerance, time horizon, and financial goals. If you're someone who can't sleep at night worrying about market drops, high-yield bonds might be your safety net. They provide income, but come with a risk of default. If you're younger with years until retirement, stocks might be the way to go. The potential for growth is higher, and you have time to ride out the bumps in the market. But there's more to consider. Let's talk about diversification. Imagine you have a delicious pie. If you slice it into different pieces, each piece represents a different investment. By mixing stocks and high-yield bonds, you can balance your portfolio. When stocks dip, your bonds might provide stability and income, reducing your overall risk. So, what's the takeaway? High-yield bonds can offer attractive returns, but they come with significant risks. Stocks can skyrocket your wealth over time, but can also plunge dramatically. It's crucial to align your investments with your personal circumstances. Now, I want to hear from you. Are you team high-yield bonds or team stocks? Drop a comment below and let us know your thoughts. And don't miss out on our next video, where we'll explore an asset class you might not be paying attention to: real estate investment trusts or REITs. Trust me, you won't want to miss it.